Go ahead, let's get started. And yeah, because we're going to continue after your presentation. So
Okay, got it.
go ahead and thank you for being here and show them.
All
Show
right,
them.
good morning. And yes, Yanko's absolutely right. So just to reintroduce myself as well as introduce myself to anyone that's new and didn't get a chance to meet me last month. My name is Jen Wagner. I'm the Regional Sales Director for our State Life Division at One America. And I specialize on our asset-based long-term care products, which is what One America's division of long-term care planning side is. So yes, last month, and I'm just going to recap kind of high level what we talked about last month. Last month, I touched on, especially here in California. I know we've got people kind of all over the country, but in California, we're seeing a tax mandate come into the state, similar to what happened in the state of Washington with the Washington Cares Fund. So, what does that mean? That means that the state is looking to implement a kind of state-funded long-term care program by taxing all the employees that are earning a payroll here in the state of California, a tax, but not just payroll tax, and not just people that are getting W-2s here in California, but they're also considering taxing people that have an income that they're filing on their state income tax as well. So that's the state of California. I touched on that, and that the timeline for people to be exempt from this state tax is kind of looming with the state of California. So not only are we seeing this being implemented in the state of Washington, and now California is probably next in line, but there are outside of California, there are 12 other states across the country that are looking to implement their own version of a state funded long-term care plan as well. So the conversation of long-term care planning, the conversation of making sure that you're educating and helping your clients be aware of why long-term care planning, just having a plan, is so important. It's more important for you as the advisor to bring up the idea of why it's important to have your clients think about long-term care planning. So long-term care planning doesn't necessarily mean we need to get you set up with a long-term care insurance policy right away. It's about making them aware of why these states are implementing state-funded program, because we're seeing a long-term care crisis right now, that Medicaid, Medi-Cal are the number one payers of long-term care cost. So with Medicaid, Medi-Cal, which is California's version of Medicaid, being the number one payer of long-term care costs, there is an issue, because what is Medicaid? Medicaid is a government program that is designed to pay health care expenses for low-income people, right? So if you've got long-term care costs eating up those resources, then the program itself is not sustainable. And that is the issue. And that is why you see a lot of states that are now jumping on this bandwagon after the state of Washington rolled out their state funded long term care plan, because they need to find a way to mitigate this problem. Long-term care costs is going to continue to rise. We are seeing a 6% inflation of long-term care cost increase every single year. So we know that it's a problem, and we need to help educate our clients why having some sort of long-term care plan, and when I say plan, that doesn't mean insurance policy, just having an idea of what they're going to do if they have a long-term care event. Are they planning on relying on their children? Are they planning on relying on their spouse? Or do they want to alleviate that burden and consider a long-term care insurance policy? We need to have those conversations with our clients, because no one else is. Right now, currently across the country, only 10% of Americans have a long-term care insurance policy. Only 10%. When we think about life insurance, when we think about auto insurance, when we think about home insurance, majority of the people know we need to get those coverages in place. But when we talk about long-term care insurance, some people don't even know that that's a thing. They don't even know that that even exists, that there's such a policy out there. So us educating and bringing that awareness to customers, our clients, is number one. So today, what I really wanted to share with you guys is the differences and the misconceptions of different types of long-term care plans out there. So I want to be able to show you the difference between asset-based long-term care, because I mentioned that's kind of my area of expertise. What's the difference between asset-based long-term care? What's the difference between that and traditional long-term care? What is this life insurance with long-term care rider? And then is that similar to life insurance with a chronic illness rider? So I want to be able to kind of share with you guys the differences and why understanding those differences is important. So I'm going to share my screen now. Let's see here. And since this is such a small, intimate group, Yanko, is it okay if we just keep it very informal? And if anybody has questions, just kind of jump right on in.
I think that's best. So guys, feel free to jump in or put a question on the chat. What she's gonna cover today might be the most important thing for you on a practical basis, because you'll be talking about this very topic with your clients. So make sure that please you're asking questions.
Yes. So, and there's no such thing as dumb questions, because I guarantee you, if you are thinking it, one of your teammates are thinking it as well. So please, let's keep this very informal. Let's keep this very fluid, and let's ask all the questions. All right, let's get past these disclosures. We don't need all these disclosures. Compliance. What is compliance? All right, so here are the 4 different solutions, and I alluded to the different types of long-term care planning solutions earlier. We have asset-based long-term care insurance policies. We have life insurance policies with LTC riders, and you'll see in parentheses here, it says 7702B. So this is important. I'm going to go over what is this 7702B. It is actually the Internal Revenue Code section 7702B. This is pertains to tax qualifications and what the government considers as a tax qualified long-term care plan. So we'll go over that as well. Life insurance policies with chronic illness riders. The government actually Internal Revenue Code 101G is actually recognized by the government as well, and what the difference between a 101G versus a 7702B is. So we'll go over that later. And then traditional long-term care insurance. We're going to start off with asset-based long-term care protection. So the way that asset-based long-term care policies work, and you'll hear it also synonymously be called hybrid long-term care. So hybrid long-term care, asset-based long-term care, they're one and the same. And the way that asset-based long-term care insurance policies are made up of, they're typically made up with a life insurance policy, a permanent life insurance policy made up of either a whole life insurance policy or a universal life insurance policy that has a long-term care rider that provides us the ability to accelerate the death benefit from these life insurance policy as a living benefit for long-term care. So that's what this long-term care rider does. That's built within the base policy of the life insurance itself. So what really differentiates an asset-based long-term care policy is this extension of benefits. So here at One America, our policy, we call that extension of benefit the continuation of benefits rider. And of course, we're in the financial industry, so we're all about acronyms. We like to shorten it up. So continuation of benefits rider, you'll hear us call it the COB. COB rider or the COB. So with One America, we call it the continuation of benefits rider. With other carriers, you'll probably hear it referenced as the extension of benefits. So what it does is once you've exhausted the death benefit pool in the life insurance policy itself for long-term care, because we, like I said, we accelerate it as a living benefit for long-term care. Once that pool's exhausted, then the policy continues to pay out those benefits for a duration of time. Now, Yanko mentioned One America is unique, and we are unique in several areas. We are the only hybrid long-term care or asset-based long-term care provider that offers lifetime benefits. So we're able to offer a lifetime of long-term care money that will never run out. We're giving your clients the peace of mind that no matter how long their long-term care event happens to be, we'll continue to pay out those benefits to them. So that's why kind of in this slide here, you see this arrow. That this arrow represents this infinite payment of benefits that's going to pay out for long-term care. One America is also the only asset-based long-term care carrier that offers two people to be on one policy. So why is this important that I mention it? Because adding two people on one policy, we put this on a second to die policy itself. So by doing this, by doing a survivorship type of policy, we're able to be more cost effective. We're able to make the policy a little bit more, I guess, cost effective is the best word, more cost effective than having two separate policies itself. And I'll be able to show you some comparatives there. So
quick question, Jen, sorry to jump in. Do they have to be husband and wife?
Yes, they have to be husband and wife, or they could be husband and husband. They can be wife and wife. They can be domestic partners. They can be, as long as they're recognized that they have a civil union in their municipality or their city or their state, they can be on the policy. And I'm going to add one more here. They can be engaged.
All right.
They're engaged. They can also be on the policy as joint. So here's an overview of features, and you're going to see this checklist throughout this presentation today because I want to be able to show you at a high level when we do a quick checkpoint on the different types of policies, what differentiates them. So with asset-based long-term care, guaranteed premiums is a check. Your clients are going to have the peace of mind that their premiums are never going to increase on them. There's no surprises. So when you present them what their premium is going to be, if they choose to elect an annual premium, what you talk about today, 20 years from now, their premium will still be the same. They're guaranteed. Tax-free death benefit. So if they don't use the policy and they pass away, the death benefit that pays out to their beneficiaries will be completely tax-free for them. There's also tax-free long-term care benefits. So when they go on claim, the benefits that pay out for long-term care expenses, completely tax-free. Because guess what? If they don't have a long-term care insurance plan and they decide to use their own money, what happens when they start taking withdrawals out of, let's say, their mutual funds, for example? They're going to get taxed on the capital gains, right? They're taking that withdrawal to pay for long-term care expenses, and any gains that's built up in that account in their mutual fund, and they start doing the withdrawal, they get taxed on it. So the beauty of having the long-term care insurance policy in place is that the benefits, when it's time to pay out, will pay out completely tax-free for them. There is guaranteed cash value buildup for them. So unlike, term insurance, unlike auto insurance, homeowners insurance, there's no cash value buildup. right? They pay the premiums into it, and if they don't use it, they lose it. So in this case here, there is cash value buildup. There's long-term care benefits known at time of policy issue. So when they get the policy, they know exactly what this policy is going to pay out for them when it comes to a long-term care event. There's benefits available for temporary conditions. So this is where I'm going to be able to share with you later on in the presentation. What is temporary insurance, temporary conditions versus permanent health conditions, and why the differences in different policies out there? You know, what do they pay for? With a true long-term care policy, true long-term care policies pay out benefits for temporary conditions, which means that they will get better. So if they get better, this policy will still pay out. And then there's permanent conditions. So knowing that they've got a permanent condition that they're not going to recover from, guess what? Long-term care policies pay for that as well. It can be referred to as long-term care insurance. This is important, especially for my folks in California. So can be referred to as long-term care insurance. Whenever these tax mandates roll out in the different states that are coming, this is important to know, because in order for them to opt out or be exempt from paying the taxes that the state may implement, it has to be a qualified long-term care insurance plan. So asset-based long-term care policies are considered long-term care plans. Continuation of benefits rider, or for some other carriers, you're going to hear it as extension of benefits rider. And then benefit types with asset-based long-term care, depending on the carrier. Some will pay out for reimbursement, some will pay out for indemnity, and we'll talk about all of that later. So you'll see for asset-based long-term care insurance policies, all of these items here are checked.
Quick question, Jen. Let's say the client has a, I don't know, IUL with a chronic illness benefit. Will that qualify as a long-term care policy for the benefit of the exemption?
No, not depending on the state, probably not. And I'll go over why. When we get to the life insurance with chronic illness rider, I'll explain exactly why these states are probably not going to consider them as a long-term care plan that they can use towards an exemption. And it goes back to the temporary conditions and permanent conditions. That's the differences.
I'm just trying to give the team a sales idea right there.
Yeah.
In part two, I would have a question from Patrick. I think about our earlier point about relationships. What about common law based on state law? Will that still allow to have to focus on the policy?
No, because we don't look at common law marriages unless they fall into the category that I shared with you, that they are considered domestic partners. The domestic partnership and civil union has to be recognized by the state, the city, or the municipality. So any one of those three, as long as they recognize that domestic partnership or civil union, we will consider that as eligible on joint policy. Or if they're engaged, I'm going to put my little quotations up here, engaged, if they're engaged. But you can't come to the table and say, okay, because they live in a common law state, they've been together for over 7 years, they should be able to be joint. We need an actual explanation. And you can tell us they're engaged or that they're in a domestic or civil union.
Thank you.
Yeah, that's what I was thinking. Just tell them they're engaged, right? Tell them.
There's my quotations right here.
Go ask her. And also with the continuation of benefits, the lifetime benefits, I was giggling and I put it in the chat notes because we all listen to Tom Hegnan, and I'm a super fan of Tom Hegna's too. And I said it's guaranteed long-term care paychecks for life.
It is long. It is. I love that. It is considered a income stream, right, for lifetime. That's completely tax-free. So I like that. All right. So what makes AssetCare? So our One America product, what makes us so unique? Number one, I mentioned this. We are the only asset-based long-term care carrier that offers 2 people on 1 policy, and the fact that we offer lifetime benefits. So not only did we were able to add 2 people on 1 policy, but we were able to extend out lifetime benefits for each of them, giving them both the peace of mind that either one of them, if they had an extended long-term care event, the other spouse or the other partner will have that peace of mind that those benefits are going to continue to pay out for them and they don't have to worry about a thing. They only have to worry about loving that person that's on claim, right? They don't have to worry about anything else. Then that's the good news. The other unique thing that separates One America's AssetCare program from other carriers is that we have so many ways to fund the policy. We have single premium. We have 1035 exchanges from existing annuities or life insurance policies. We could do an annual premium. We have, for outside of California, we have 5 pay options, 10 pay options, 20 pay options, and then pay to 95 options. In California, we have 10 pay options, 20 pay options, and life pay options. And lastly, we're the only carrier that has a turnkey solution using qualified money, using 401k or 403bs or IRA money to pay for a life insurance, a long-term care policy, and be able to add their spouse on the policy using an individual's retirement account. So that's another thing that separates us and makes us unique. And then lastly, when you compare us in the long-term care carrier space, we are a market leader in asset-based long-term care protection. We are one of the top asset-based long-term care providers, and we have strong financials. And being a mutual company helps as well, because we don't answer to Wall Street. We're not beholden to Wall Street. We're beholden to our policyholders. So we're not trying to make shareholders money. We're just trying to do the right thing for our policyholders. So here's a comparison. I'm not going to tell you who the competitor is unless you ask. If you ask, I can't lie. But these are updated numbers from just a couple of weeks ago to kind of give you a comparative between our competitor in the asset-based long-term care space versus a joint policy here at One America. Okay, so since we are the only carrier that does joint, I had to separate out the premium with our competitor. So you'll see that there's a male 67 and a female that's age 64. They're a married couple. So we're going to do $100,000 premium for the husband, $100,000 premium for the female. You'll see what the guaranteed death benefit is for each one of them. So the husband, you can see, is a little bit less just based on mortality tables. Men have the tendency to pass away a little sooner than women. So that is going to affect what that monthly long-term care benefit is. So for our competitor, the male, the husband, his policy, that $100,000 is going to provide him $4,858 a month in benefit that will last only 6 years.
Good. Are you guys still there?
Me?
Yeah.
Okay.
Can you hear us? You paused for a second.
Oh, okay. It's saying my internet connection's unstable.
And so right, guess what? You got your question. Who is the competitor? Elaine.
Oh,
Elaine
okay.
asking.
It's nationwide. Care matters.
Okay. We won't tell.
Don't tell. So for the wife, her $100,000 premium is going to provide her a monthly benefit of $5,733 a month. That will last only 6 years. So here are some claims example. If the husband, by year 2, his policy is going to pay out $116,000 in benefit. By year 4, that total will increase to $233,000. And then by year 6, the total amount, which will mean that his entire pool has been exhausted, is $349,000 in benefit. And then that's it. That policy is done. Okay, so if he needs more long-term care benefits to pay out after year 6, he's going to have to figure out a plan, or his wife is going to have to figure out a plan for him to figure out what account are you comfortable in liquidating next after you've exhausted your policy.
Don't you love it when the video freezes on your face and you're making a face like that?
It's priceless.
You're muted, Junko.
Oh, sorry. I was just saying it's just trying to keep us in suspense about the One America solution. Sorry, we couldn't hear you, Jen, after you were done with Nationwide.
Oh, okay. So back to so there's Nationwide. So that's kind of the benefits that's paid out with Nationwide. So now let's pivot to AssetCare. Let's pivot to what One America's same amount of premium is going to look. So now, since we do joint, we're going to combine both premiums. We're going to take the $200,000, combine it. It's going to provide one death benefit. Remember, this is on a second to die policy. So the death benefit that's going to pay out if both of them were not going to need a long-term care claim is $245,000. But here's where it differs. That $200,000 is providing each of them $7,351 a month in benefits for life. So let's look at the bottom of the example claims now. By year 6, if both of them were on claim, this policy is paid out over $520,000 to each of them versus the Nationwide policy. And that is the power of having the AssetCare policy, being able to do joint and being able to add lifetime. Questions so far on these comparatives?
A comment for you, but a question first, Jen. Again, trying to give the team something to think about. You sent a video, well, you and your team, the coffee breaks, right? So I want to see if anybody actually watched it. When was the first AssetCare policy issued by One America? When did they come up with the product? What was the year? You guys remember?
I just remember it was like 35 years ago. So whatever year that was, I thought something like that.
Close enough. It was 1988, right? Or did I get it wrong?
1988.
1988, exactly right. So yeah, so about 35 years ago. I'm telling you this because you're gonna hear this from competitors. Well, you know, the product is not priced correctly, or it's gonna create problems for One America. I'll let you answer that comment, Jen. But we have had the product for 35 years, still going strong. So it seems to me pricing is not the problem.
Yeah. So Yanko, you bring up such a great point. Aside from One America, there's only one other carrier that has the asset-based long-term care experience that we have, meaning the length of time that we have, and that is Lincoln MoneyGuard. So between One America and Lincoln, we have been in this space for over 30 years. Like Tawny mentioned, 35 years. And that's a long time to make sure that if there's a claim, that we're able to be financially stable enough to continue to pay out the claim. Because at the end of the day, why are your clients buying these policies? They're buying these policies because they want to make sure that when they need it, the policy pays out. And so when you have that type of length of experience, this is where you have consumer confidence that what they are purchasing is going to work the way that you told them it was going to work. We see right now, and you probably have heard or have personal experience or have seen other competitors. And I'm not just talking about long-term care policies, insurance policies. I'm talking across the board with different new products that come out. What do we see when new products come out? They come out a few years later, they pull it away, and then they like create a new product, right? We see that. And the reason why is because they didn't price it right. They put it out, they try to get a lot of buzz, they try to get people to get the policy, and then all of a sudden they're like, ooh, we're gonna be hurting. We're not gonna be able to maintain the sustainability of this policy at this price point. So either A, we have to increase premiums, right? And then what happens when premiums get increased? You know, people are like, oh, I get sticker shock. Or they change the product altogether and they change it to make it look completely different than what it used to look like. And then they say, we're pulling the old product off the table because they didn't price it right. With One America's AssetCare policies and our annuity care policies, we priced it right. We're not, and I'm going to be honest with you, we're not the cheapest, right? And I hear a lot of agents, including clients, tell me all the time, Jen, the way that this policy is designed, it's too good to be true. And I say, yes, it's too good to be true when you're comparing it to, especially when you're comparing it to other carriers out there, but it's not too good to be free. You are paying for it, but you're paying for the confidence that when you need it, this policy is going to be paid out, because we have not just the product experience, the length of time that this product has been around, but we have the claims experience over 30 years to back up our product as well. So thank you, Yanko, for bringing that up, because that is so important to share with your clients.
Yep, I know it's a little bit of inside baseball, but it's important for you guys because you will get that from brokers or clients are talking to somebody else or whatever, and the benefits are significantly higher. Well, you got your answer.
Yes. All right. So we're moving away from our asset-based long-term care to life insurance with long-term care riders. What's the difference between this and asset-based? You just told me, Jen, that you're working off of a whole life insurance or a universal life insurance that kind of has a long-term care rider. So what's the difference between that and then a life insurance with a long-term care rider? Well, I'll tell you, the base structure looks very similar. It's going to operate off of a whole life insurance policy or a universal life insurance policy. And you're going to add that long-term care rider that accelerates that death benefit as a living benefit for long-term care. Starting to sound familiar, right? Because it looks just like the last product that we just looked at. But here's where it differs. See that continuation of benefits? They don't have a continuation of benefits. They don't have an extension of benefits rider. So what does that mean? That death benefit pool, once it gets accelerated as a living benefit, that is it. That's your entire pool. You're done. Once that policy is done, now you got to figure out what other account are you going to tap into to pay for long-term care when that death benefit runs out. So looking at that comparative, you can see here are some of the differences, because when we looked at asset-based long-term care, all of these checkpoints were all greenlit. This is where things differ. The guaranteed premiums is kind of because you're talking about a whole life or a universal life premium, right? So those typically stay pretty stable. It's that long-term care rider where it may differ. Depending on the carrier, they may charge an additional premium to add a long-term care rider. Guaranteed cash value, depending on if it's a whole life policy or universal life policy. A lot of universal life policies don't have the cash value build up the way whole life policies build up. And then the continuation of benefits rider or extension of benefits rider does not exist with a life insurance with a long-term care rider. And that's the big difference between an asset-based long-term care policy and a life insurance with long-term care policy. So this is where, when they go on claim, I was kind of sharing with you, we're going to utilize the death benefit pool as kind of the basis of what their when they go on claim on a long-term care policy. But once that policy gets used, once that pool gets depleted, that is it. There's nothing else. So why am I bringing that up? Why is that important? Because I mentioned What America is the only carrier that offers lifetime benefits, right? Outside of traditional long-term care. Asset-based or life insurance with a long-term care rider, we're the only carrier that offers lifetime. So here's a plot point. This is the problem that we have with people saying, but the average stay in for a long-term care is about 3 years. I get thrown that all day, every day. Jen, the average care time for people with a long-term care event is 3 years. So I don't need lifetime policy, or my life insurance policy with the long-term care rider is sufficient. Let me show you why that theory doesn't really make sense, and it's not a good way to judge. This plot point represents your X and Y axes here. That represents age, their age, and how long of a long-term care event they have, okay? You'll see these plot points they're all over the board. Some are younger with a short claim. Some are older with a short claim. Some are young with a long claim. Some are older with a really long-term care claim. But if we took the average, here's the average. You draw that line across all your plot points, and how many plot points did it really go through? What? Out of like the 100 dots that's in front of you here, it probably went through 10. So when you look at averages and you've got a lot of people that are all over the board, but the average really only encompasses about 10% of the people, did you do the right thing when you agree with them that 3 years is enough? That 3 years is the average. When you look at this, look how many people have an extended long-term care claim. Look at what's above the line. So this is why when we're trying to help educate our customers, these data points are important to share with your clients as well. That's part of the education process, because your clients are listening to their friends, they're listening to whatever they're reading on the internet, right? Or Facebook or social media, and we know how true some of those things are. We need to be able to show them properly and appropriately the danger of going by averages.
Let me make a point about that, Jen. That's so true, guys. And that was one of my eye-opening experiences at One America when I came over. And as a matter of fact, I trained some of you this way because I was trained that way. Look at the average, you buy for that, and it's all good, but it's not good, right? And a second point, more of an inside baseball, Jen, maybe you can speak to this. People that do this play on the average, let's say on a universal life policy. What is the impact on that long-term care rider when they're taking loans for retirement, and that benefit continues to drop substantially? How does that affect them when they actually need to go on claim?
Yeah, so if they borrow, let's say whether they borrow or they take a withdrawal out of their policy, it proportionately reduces their benefit. So if they reduce their cash value by 50%, guess what? Their benefit reduces by 50%. It's going to affect their long-term care plan when they're of age or when they need it.
That was my other eye-opening experience, guys, too, that there is value in putting these separately from their quote-unquote retirement plan or retirement insurance plan, because what we just said, if they have, again, an IUL and they're planning to use that product for all-in-one retirement long-term, well, they need to understand that as they make withdrawals, they may not get sick at 65, they may get sick at 75 or 82. Well, the policy is going to look really different at 82 than the way we're projecting at 65 because of the policy loans, right? So I know it's inside baseball, but very important. Again, the sales ideas, you're talking to the client, they say, I already have this, I have this IUL with XYZ company. Are you planning to take policy loans? well, time out, it may not do what you think it's going to do.
That's
Sorry.
right. Nope, that's right.
Key phrase of the day: it may not do what you think it's going to do. So let's take another look.
That's right. So here is another comparative. So this is a life insurance policy with a long-term care rider versus what one of our One America AssetCare policies are. So not going to tell you who our competitor is unless you ask me. So
Come on, Elaine, you can do it. We're waiting for Elaine to ask. Where are you, Elaine?
I'm just a slow typer. I'm asking. Just a second.
Okay.
Or you can ask it out loud. I'm going to assume you're asking it aloud, Elaine.
Well, we're recording, so I'm going to put it in the chat.
So
Perfect.
it's Guardian. So Guardian has their life insurance with the long-term care rider. So what I did here is I did a 10 pay because that's common with a lot of our life insurance policies, our whole life or universal life policies with a long-term care rider. They'll structure it as a 10 pay. So we've got $10,000 a year in premium that's going to go into this policy for 10 years and then it's paid up. This is for a woman that's 54 years old. Her minimum death benefit, or I should say, when she activates this policy for long-term care, the maximum death benefit is $131,499. When we accelerate this is at an acceleration of 2% with Guardian. It's $2,130 a month that will pay out for 50 months, so about 4.5 years. So let's look at the claims here for her when she goes on claim. At year 2, this policy is going to pay out $51,120. By year 4, the policy is going to pay out $102,240. But because we're only accelerating not the total death benefit of $131,000, it is only going to be a certain percentage of her total death benefit because they want to leave a residual death benefit on this policy. The maximum that's paying out by year 6, so this is after 4.5 years, the maximum amount that they're paying out is $106,500 off of $10,000 a month in benefit or premium for 10 years. Let's pivot to AssetCare now. Same $10,000 a year premium for 10 years paid up. Same woman. Her death benefit's a little bit higher. It's at $148,612. Her monthly benefit's $4,458, but we added the lifetime rider for her. So now by having that, she's almost doubling her monthly maximum benefit, and we've increased her duration, her long-term care duration to lifetime. By year 6, you can see the comparison. We've paid out almost $321,000 in long-term care benefits versus her Guardian policy.
That is so starkly insufficient. That $21.30, that's paying out $71 a day.
Yep. And knowing she's 54, she's not going to need this policy for another 30 years. So by year 30, that $21.30 means nothing. That's nothing.
Yep.
You can't even get a hotel room for that price. And it reminds me of that song, Nothing Compares to You.
That was a good song, though.
Obviously, Jen cannot say this, but I'll say it's the same issue with Mass Mutual, guys, because we just replaced 2 policies ourselves in the last month or so. That when we're looking to replace one more, it's exactly the same problem.
Yeah, I talked to somebody at Mass about it too, and I was like, no, you don't even come close.
Yeah, but that's the misconception, because agents that sell long-term life insurance with a long-term care rider, they're selling it for the life insurance first, long-term care secondary, and then they miss out the whole point of why the client was interested or needs long-term care protection. And we need to reverse that mindset, right? We need to reverse it. Bianco mentioned it. This isn't about you trying to package it as an all-in-one. Here's your life insurance and your long-term care. One policy covers it all for you. You got to have separate plans. When we're doing appropriate planning, you've got your life insurance policies. That's going to cover you as either legacy, final expense, whatever it is, right? This is what's paid out when you die. Then you need to have a separate plan for long-term care while you're still alive to protect and preserve your assets currently, right? So if you are legacy planning, we need to be able to protect it. And this long-term care plan is going to protect it for you. But now we need to educate them that just because it's on a life insurance chassis doesn't mean that life insurance is number one. Life insurance chassis basically means that we've designed a long-term care plan with guarantees in place. And in order to have guarantees in place, we need to build it off of a foundation from a permanent policy. That's how we're going to ensure that if you don't need long-term care, if you are lucky enough to die in your sleep peacefully, we want to be able to have something paid out to your beneficiary. So the money that you put into this policy was for naught. That's what we're trying to ensure for you. We're also trying to ensure that you're going to have guaranteed premiums. We don't want you to have the, 30 years down the road, an insurance company didn't price their policy right, so they're going to jack up the premiums on you. We don't want that to happen. We want to give you peace of mind when we do a long-term care planning solution for you. So that's kind of, the difference between educating our clients between an all-in-one, like Yanko was mentioning, like some agents do, like, oh, I'm going to give you life insurance and long-term care. You're always going to be covered for everything. That's not true. So we're going to move into life insurance with chronic illness riders. And I will tell you, this is a big one. Ask as many questions as you want on this one. Clients, or I shouldn't say clients, agents. We have a lot of agents, which is another reason why there's only 10% of Americans that have a long-term care insurance policy, because we have a lot of agents that maybe not by their own fault, maybe they had a wholesaler that didn't educate them correctly, but have taught them that life insurance with a chronic illness rider or a critical illness rider or an acceleration of benefits rider is a long-term care rider, and it is not. So what makes a life insurance with chronic illness rider different? Well, it starts off kind of looking the same. You've got this life insurance policy, whether it's a whole life policy or a universal life policy, but there isn't a long-term care rider that accelerates that death benefit as a living benefit for long-term care. In fact, the rider that's attached to it is a terminal illness rider or a chronic illness rider. And there's definitely no continuation of benefits or extension of benefits rider that's added onto this policy. So let's dig into this a little bit more. Here are some of the differences with a chronic illness rider versus what we just looked at. Definitely no guaranteed cash value that you're going to see when it's tied into, let's say, just the chronic illness rider portion of the policy. There's this kind of maybe on the chronic illness benefits known at time of policy issue. Sometimes a policy is issued and you don't even know what those benefits are. Like, when is it going to pay out? How is it going to pay out? Sometimes that's not really known at the time of policy issue. You kind of find out when you're ready to activate that rider. Benefits available for temporary conditions, and we're going to go over that. And then you're going to see, like, it cannot be referred to as long-term care. Misconception, number one misconception, and I hear it all the time, where clients believe that the policy that they're holding is a life insurance policy with a long-term care rider. And when I look at the policy and I read the contract itself, it is a 101G. It is recognized by the IRS as a chronic illness rider, not a long-term care rider. And then, of course, there's no extension of benefits. So why can it not be referred to as a long-term care policy? Here are examples of the different riders that you're going to find depending on what the carrier or who the carrier is. You'll hear it. I've already mentioned some as chronic illness riders, extension of or accelerated benefits rider, critical illness rider, terminal illness riders. These are some others. All all these names are there to confuse your clients. They make it sound fancy, and they make it sound like, oh, it's long-term care. It's not. It's not at all. So here's where it differs. With chronic illness riders, in order to calculate the benefits, there's actuarial discounting involved. So what they do is they may take into their age, their gender, and what the current interest rate is to determine what amount off of that death benefit will be available to be used as a chronic illness event or terminal illness event, something that's considered long-term or permanent. So chronic illness, this is where they're going to vary depending on the carrier itself. Licensed healthcare providers do have to certify that the insured has a permanent chronic illness. They have to have a permanent condition in order for the carrier to activate the chronic illness rider. And it has to last for the rest of their life. This is what separates a temporary condition from a permanent condition. It's got to last for the rest of their lives. So benefits are available for certain types of health conditions under chronic illness and long-term care policies. So you're going to see an overlap in these conditions. And that's okay with long-term care. We want these overlaps because long-term care is going to encompass a lot more illnesses and conditions for the policy to pay out than a chronic illness rider will. So here are some permanent, non-recoverable conditions. These are permanent that's going to last for the rest of their lives. Cognitive impairments like Alzheimer's, dementia, ALS, Parkinson's. You'll see Huntington will fall under that. Right now, there's been a rise with MS. That's going to be considered permanent, non-recoverable conditions that both of these policies, whether it's a true long-term care policy or life insurance with a chronic illness rider, will cover. But this is where the temporary conditions, chronic illness rider will not cover, but long-term care will cover. So recoverable conditions will be, or temporary conditions would be strokes, certain types of cancers, accidents and falls, right? Accidents like a car accident, or maybe you're hiking and you get injured. Maybe you fall off the hillside and that's considered an accident or a fall. So those are considered temporary, and those are conditions that long-term care policies will cover. Now, the other thing with chronic illness riders that I want to share is tax treatments. So a lot of them, when they accelerate a portion of the death benefit to pay out for long-term care, they're going to take into consideration the IRS per diem limit. Currently this year for 2023, the IRS limit is $420 a day. And it cannot exceed that. Otherwise, anything in excess of $420 a day that's paid out of the chronic illness rider, guess what? It's going to be taxable on the client as income. And you can't tell them what that per diem limit is at the time of the policy being issued because you can't forecast into the future. You can tell them this year, it's $420 a day, but I can't tell you what it is next year because I'll tell you last year for 2022, it was $390 a day, right? And then all of a sudden in 2021, it was $400 a day. So it dropped in 2022 by $10 a day, which is weird. So the IRS is going to set these limits however they want to set the limit, and you can't predict the future. So this is where, trying to tell them, oh, you're not going to get taxed or it's going to be tax-free. It's not with chronic illness riders.
We got a question, Jen from Sharadi. What about autoimmune disorders like fibromyalgia, Epstein-Barr, lupus, rheumatoid arthritis? I guess, can that trigger the benefit from the AssetCare?
Absolutely. Absolutely. Because with long-term care policies, right, as long as the client is unable to perform 2 out of 6 activities of daily living. So dressing, transferring from, their bed to a chair, or from a chair to a couch, or feeding themselves, or going to the bathroom, or holding their, bowels in. Those are considered activities of daily living. If they're unable to perform just 2, guess what? That policy is going to trigger and it can pay out benefits. So here are limitations with indemnity payments, the differences between indemnity and reimbursement. All of our One America policies do pay out for reimbursement. Why? The misconception, I think a lot of people, customers, especially customers, when they think about reimbursement versus indemnity, the word reimbursement makes them believe that they have to pay out of their own pocket first before they get reimbursed, right? But reimbursement, all it means is that we, as the insurance carrier, will reimburse for the actual cost of care. We're not going to pay out anything in excess of what the actual long-term care cost really is. So One America offers direct billing, which means the provider can bill One America's claims department directly, and then we send out payments directly to the provider. No different than you see with like your medical insurance or your health insurance, where the provider bills the insurance company directly, and then anything over and above what the limits on that medical plan is, then the provider sends you a bill for the differences. One America will do the same thing. So with that knowledge now, why is that a better thing? Family members don't have to mess with the actual billing and don't have to sit down and try to itemize a bill and write checks and pay it out to the provider, because the insurance company already took care of that, which allows the family member to really focus on caring for the insured, right? By doing reimbursement, it allows the carriers to lower their cost as well, because they're only paying out for the actual cost of care. It also eliminates any paperwork. So no need to keep receipts, no need to maintain all of those invoices for the end of year tax filing, because you're going to have to file taxes with indemnity. You've got to show proof of the actual long-term care bills so that you don't get taxed on them. Otherwise, anything in excess of the per diem, the IRS per diem, which we mentioned $420 this year, and anything that's above that $420 that's not long-term care costs, gets taxed to your ordinary income tax. So that's where, when you do reimbursement, we can truly say it's 100% tax-free. So here's a comparison, but this time I'm going to tell you who it is. I'm showing you the difference between One America's Whole Life Select with the chronic illness rider versus One America's AssetCare. So I wanted to show you the difference. So with the kind of the left side here, the One America Whole Life Select product, we're doing $10,000 a year premium for 10 years for both the husband and the wife separately. You can see what the death benefit is for each of them. But here's the way that they calculate, how One America does their actuarial discounting and calculates what the amount of chronic illness benefit is going to be provided from this whole life policy. For the husband, so what we're doing is we take 50% based on his age of 65. That means his percentage that we're going to use is 50% of the net amount of risk. So 50% of the net amount of risk provided us $43,595. Then we take the cash value at the time that he goes on claim, and we're going to assume at year 5. That's $36,298 at year 5 is the cash value that he's got available in his whole life policy. When we add those two numbers up, his total maximum benefit amount for his chronic illness rider is $79,892. That's the amount that will pay out of that policy. So now let's look at the wife. She doesn't go on claim until year 7. So we take, again, she's age 65. So her percentage that we're going to use is 50% of her net amount of risk, which calculates to $37,827, plus her cash value at year 7, which is $54,030. So her total amount that she has available to use for her chronic illness rider is $91,857. Let's pivot over to AssetCare. Now you can see with AssetCare, we're going to combine their premiums of $20,000 a year over 10 years. This is a joint policy, so their combined death benefits $175,000, but the monthly benefit that they will each get is $5,271 a month per person for each of their lifetime. So now you can see by the husband at the end of year 5, he gets $316,000 of benefit paid out in 5 years. 7 years for the wife, $442,000. Totally exceeds what that whole life select would have paid out if we were selling the whole life select with a chronic illness rider as their long-term care plan. Make sense?
All right, guys, this may be the most important slide of the whole meeting. Any questions on this? This is your sale right there. Sorry to be so motivated, but again, I'm trying to make you guys make a great income. This is the analysis that you will make with the client, that we will make with the client. Look at what you have, look at what you can get, right? This is the analysis right there that we could do for them.
I'm going to add one more thing. So with the whole life select, in order to get the chronic illness rider added onto the policy, they can't be table rated. Am I right, Yanko? They can't be table rated. If they get table rated, then that chronic illness rider is not allowed on the policy. Is that correct?
I think it's table B or it is standard, right? Anything beyond standard doesn't go in. I think you're right. Jen. I think you're right.
So with AssetCare, so keep this in mind. Let's say you're applying for a whole life select with a chronic illness rider and your client gets table rated anywhere from table 1 through 4. Tables 1 through 4, you pivot to AssetCare, they're getting preferred rating. So although you said, I'm so sorry, your whole life select, you were table rated 2, guess what? The minute you pivot to AssetCare, you can say, congratulations, you're preferred.
That's a great point. Elaine, you have a question?
Yes. So I want to see if I understand this correctly. I'm talking about the whole life select. What we have here is reimbursement or indemnity. Is that right? Reimbursement meaning that the carrier is billed for the actual cost of care, and if the client receives a benefit above that, then they are going to be subject to income tax.
Right. Anything above the per diem of currently this year, yeah, 420.
Above the daily per diem. Okay. I just need to be able to say it to know I understand it. Okay. Yeah. Thank you.
You're welcome. And with the chronic illness rider, those are all paid out as an indemnity. So that's why it's so important that the per diem conversation is brought up so that they understand that each year it could change what is considered taxable. So they may get that surprise 1099, 5 years from now. They're like, what is this? Why am I getting taxed on this amount? Well, the per diem income, the IRS per diem limit changes. So we can't predict in the future what that limit may be. It could be higher, it could be lower. We don't know.
Quick question, Jen. We got a question from Fabian about international benefits. Let me just read for the team what the illustration says. International facility and home health care services. We will pay benefits for qualified long-term care services received in an international facility if an insured qualifies under the conditions defined in this rider, and if the insured receiving qualified long-term care services in an international facility. So can you expand on that, Jen? So your answer is yes, but I'm sure there's more details to that.
Yeah, and it really depends on what state. So which form of variation of the product you have. So California AssetCare is on our older generation AssetCare, and then outside of California is the newer generation of AssetCare. So those international coverages look different. So in California, it's international coverage, doesn't matter which AssetCare product in what state. It's just the base policy. So it's just the whole life portion of the policy that's covered. And it will be covered as long as that particular country isn't sanctioned. So
Okay.
we don't know what that could be 10 years from now, what countries are sanctioned and what countries are not. But you always want to let your clients know that as long as the country's not sanctioned, they don't fall under our OFAC list, the government list of sanctioned countries, then it will pay out benefits in that country, but only from the base policy. So whatever that death benefit may be. In California, we're going to pay out 50% of whatever the maximum monthly benefit is for, oh no, I'm sorry. We only will pay out the full monthly maximum benefit in California up to 12 months. And then the goal is to bring them back to the United States to finish out their care. The newer AssetCare version outside of California, we will pay 50% of the monthly maximum until we exhaust the entire base policy death benefit pool. And then the goal is to bring them back to the United States to finish out their care. But outside of California, Canada is considered part of the United States in the sense that we will pay out full benefits. The entire AssetCare policy is recognized in Canada.
Makes sense. So key takeaways, guys. Number one, do not retire in North Korea, number one. And number two, Canada is the same thing as the United States, apparently. So good to know.
Yes. So lastly, this takes me to the very last type of long-term care planning, and that's traditional long-term care insurance. So long-term care insurance is use it or lose it policy. So there's no guarantees in place. There's no cash value, no death benefit. If they don't use this policy, they lose it. I mean, so notice that it's not on a life insurance chassis. It's similar to health insurance, that instead of paying out for any type of medical claims, it's going to be just long-term care claims only. So long-term care benefits will be paid out. It is tax qualified. It is recognized by the IRS as a 7702B policy. You heard me mention that earlier. So there's no COB rider either. So it's kind of like no extension of benefits or whatever they purchase as a pool, or there is one carrier out there that offers lifetime benefit, then that's their benefit if they use it for long-term care. So that's kind of the best way for me to describe it is however you think of auto insurance or homeowners insurance, long-term care insurance, traditional long-term care insurance looks the same. There is potential for future rate increases. So keep in mind, we see this with auto insurance, home insurance, anything that's that doesn't have guarantees in place. The higher risk you are of filing a claim, that means your premium is going to be higher. So the older you are, your premium is likely to be much, much higher than when you're younger, because your risk of activating a long-term care claim when you're older, much older, is much greater. So those are kind of the risks that your clients will have to take, that, okay, it appears you're paying less on a traditional long-term care policy now, but what is that going to look like 20 years from now, 30 years from now, when you're getting close to needing to activate that policy? There's much tougher underwriting standards as well. So we see a lot of clients that have gotten declined with traditional long-term care policies, where agents will pivot them to One America and they'll get approved. And a lot of times they'll get approved, preferred. So here's the checklist again.
Go ahead, Elaine, you have a question. We can't hear you.
It would be great if I unmuted myself. Okay, so I'm asking this question because I have a client who has had a long-term care policy for about 15 or 20 years. Is when we are, does One America consider the cumulative coverage that a person has? So she has the old, this particular type of long-term care is traditional. In the underwriting, does One America consider cumulative coverage? We may be comparing apples and oranges, but I'm just wondering, is there a limit on how much long-term care she can have? Because she may not want to turn this other one loose, even though it's, obsolete.
Absolutely. So you can stack benefits. We encourage that as well, because some clients may have at the time years ago purchased the policy with, what they felt was sufficient benefit limits at the time. And then with knowing that our long-term care inflation is 6% currently, that it may not be sufficient anymore. So getting another policy to supplement her current policy is definitely advisable. Now, the difference is what the insurance companies will do so that there's not an overlap in paying for the same benefits, especially with reimbursement, is that we will coordinate benefits payments.
Thank you.
Good question. So this concludes the presentation, the differences that I just went over with you, and the different types of policies that are out there. That checklist, I'm bringing them all back together so you can see them side by side. You'll notice asset-based long-term care insurance is the only policy that's going to cover all the things on this checklist that will provide your client peace of mind. Everything that they always question about. Asset-based long-term care insurance is the only type of insurance that's going to give them that peace of mind that will check off all of the items on this list compared to some of these other ones. So again, is asset-based long-term care going to be for all of your clients? Absolutely not. Absolutely not. So is there room for some of these other types of policies out there for some of your clients? Absolutely. At the end of the day, whatever decision that your client makes, or any decision or recommendations that you provide your clients, there's really no wrong decision. There's only one wrong decision. The only one wrong decision is not having a plan. Not having a long-term plan is the only wrong decision that your client may have. Otherwise, there's going to be a fit for them in all of these categories, but I wanted to be able to kind of show you the differences and educate you on why there are differences out there.
Awesome. Any questions, guys, before we wrap it up today? Any questions or comments on what you saw today? And as you think about it, I'm going to say we're going to continue talking about this. Great product for your practice, great product for your clients. Very unique. I think in the next upcoming meetings when Jen's come back, we'll talk about annuity care as well, which is another option that they can use, another way to pay for it. So again, you can do so many things with this. That's why I like it, because it gives me so much more flexibility when I'm doing my overall holistic plan with the client. So I'm not forced into one corner specifically. We can do different things. And that flexibility is what I think is great about this product. So, but if you guys don't have any questions.
Well, I have a comment real quick.
Go ahead.
One of my main takeaways, because I focus on this so often, is the argument, that you brought up, Jen, about some of the clients are saying there's no way, that they can do this for life and all of that. Right. But one of the key phrases that you used and that I use all the time is, why are they able to do that? Why are they able to price it this way? Why is it effective? It's because it starts with a solid foundation that supports it. People don't think about financial foundations. They don't know what that means.
Mm-hmm.
So that was really key to me. Because it really touches what I try to teach people all the time. If you start from a place of a good financial foundation, and you probably don't even know what that is, go Google the term.
Yep.
That's very key.
Yes.
So thank you for that.
No, I agree. Thank you for re-emphasizing that, Tawny. That's absolutely right.
All right, guys. Well, unless you have any questions, we'll let Jen go. We'll continue ourselves for 5 more minutes or 10 more minutes. But Jen, thank you once again for such a great class and training, and we'll see you in a couple of weeks again.
All right. Thanks, Yanko. Thanks, team. Bye-bye.
Thank you, Jen. Bye.
All right, guys. Well, I'm not going to take too much of your time. We'll finish at 10:30. You'll get a break because Jen was here. But I just want to bring a good point or an additional point, I think, that is relevant to our conversation today. One of those Harvey already asked, which is, okay, well, can we combine a banking design with this AssetCare whole life based product? The short answer is no, you don't really want to do that for a couple of reasons. Number one, the whole life policy that is used for AssetCare, it is a different company, right? It's within One America, but it's State Life, which is not designed for cash value. It's not designed for policy loans. You could take a policy loan, but it's going to create problems, right? So you really, that's what is called asset care. You're taking an asset that you're reallocating, and then you cannot leave it alone because that's to protect for that future risk. So you're not spending the money. I tell my clients, if you give me 100,000, the 100,000 are still there. We have cash value. You have a debt benefit. If you never use it, you're gonna get your money back plus some, right? But we are reallocating an asset to be able to cover that risk. But I wouldn't use that as a banking design. So you really want to separate those two things. The banking is for an ongoing situation with loans and pay back and take it out again and all that stuff, all that maneuvering. That's what your AUL policy would do. If it's designed correctly, you want to keep the State Life alone.
Hey, Jonko, on that point, I was talking to my sister a while back. She's had some life issues and we haven't put this in place yet. But what I proposed to her, and she was really interested in doing it this way, she wants a banking policy, but she also needs long-term care. So I was like, well, you can take some of your, like if you take $12,000 a year as a policy loan out of your policy, you can pay for both things and still have $4,000 left over in liquidity to use for other things. But then it's purchasing her long-term care policy, and she's got her banking policy going at the same time. So I don't know if there's a problem with that, but
as long as they're separate, it's fine. Yeah, so as long as because again, you don't want to mess with the loans on the AssetCare product because
right.
That's the benefit and effect. So you just want to leave it there. It's a risk management tool. You leave it alone, and then you have a separate policy to do the loans and the payments and back and forth and
yeah.
And all that.
Exactly what I was proposing for her, and she was really interested, but she had a life event, so we've got it on pause for now.
Yep, that's the best way to do it, I think. So the other point I wanted to make, we go back to our, I don't know, building a house, building your financial plan. You guys know we've done this before, right? So here you have your guaranteed money, the money that pays for food and shelter, right? This is the money that you cannot afford to lose. Then you have your investments here. Then we have your real estate here. Then we have business interests over here. And that's kind of like your risk, how you build your holistic plan, right? That we stop digging, we take care of the money that you need, or your financing needs, that your IBC concept. Then we go into those guarantees and the money that you cannot afford to lose. Then we get into more aggressive investments, real estate business, all that good stuff, right? You guys should remember these from our previous classes. That's the way we build a stable financial structure. My question for you is, if you guys want to jump in and participate, is where does this asset-based long-term care, where does this go in this process?
Money you can't afford to lose, I would say.
Okay. Anybody has a different thought?
Yeah.
I think it's probably going to have to go above that.
Okay, go ahead, Elaine.
Okay, I was going to say that 2 answers. First of all, it depends on how old they are. Okay. Mm-hmm. If the person is 40 something, then I would possibly put it in the investment thing right there. But if the person is 60, they're going to go underneath that if they have the money, because they have a more immediate need.
Okay, that's another take. Anybody has a different take? All right. Well, I'll tell you my take. I agree with Harvey. I think this goes right there. Why? And I will deviate from Elaine's point about the age, because as you saw in the presentation, this also covers things that you can recover from. Can a 38-year-old get a stroke? Yes. Can a 45-year-old have a hiking accident like she was saying? Yes. Or some of the diseases that Shirley put on the chat. Yes, yes, yes. And what happens is that if you are in a situation like that, where you have no income because you are unable to work because you have a long-term care need, you're going to spend these dollars to be able to pay for that. So that's what I will place this conversation right here at the bottom, because this protects these other assets.
Oh, well, duh. I don't know why I said that, because that was what I was just describing for my sister. She's only in her 40s. And I put it right there in the same bucket that you just said.
It's a play with the word asset care. Well, it protects your assets. It protects your other investments, because you don't want to have to sell your building or your real estate just because you got to pay medical bills, right? It's the same point with health insurance. That's why it goes right there. Because if you get sick, you don't want to have to sell your cash or your 401k to pay for that. So that's what I will put it. So as part of your conversation, not initially. Again, we cannot talk about the client about everything in that first meeting. You continue with your same process. You start with your IBC, you start saving. You always start right here, right? Because that's what most people don't have. And then you build. But as you come back for your 6-month review, your annual review, and those things are taken care of, we got to keep expand our plan. Well, now let's talk about these things that we may not be able to afford today, but this is what I would like us to work towards, right? Because we know that you're going to need these down the road, right? And again, it could be a reallocation of assets, could be a policy that you start from scratch. And that's why I also like what she said about stacking benefits. You may start with a contract today that covers what you think they'll need, and you may have to do something 20 years from now once they get older, because now prices have changed and you need additional coverage, right? Maybe an annuity care or reallocation of some of their savings, or who knows, even maybe taking some of the life insurance cash value to allocate toward annuity care or an asset care via 1035 exchange. You could do that as well, right? So again, lots of options, but I'm not saying this should be your primary drive on a 30-year-old. I don't think that's the case, but I think it fits right here as part of your, we gotta protect all your corners before we do anything else. Questions on that?
I just want to really stress the thing about long-term care is if you don't have coverage and you need it, no matter what age you are. I had a really good friend who was in her 20s. She got diagnosed with diabetes. She was in very, very bad shape. She had to go into a long-term care facility for the rest of her life. And she was also in a car accident. And so for the duration of the rest of her life, she was in a facility. And she was 28 years old when it happened to her. So, but the other thing is that if you don't have long-term care and you need it, it can literally bankrupt you and beyond. Everything that you own is at risk. Everything.
Exactly right. So I agree with Tony. So last point, and I'll let you guys go. Jen brought about chronic illness and critical illness. Does that mean does that mean they are bad riders? Does that mean they're bad benefits? Not at all. For a lot of young people, these two things are the bridge, right? So you have that 30-year-old that had a $500,000 policy, which is going to provide $150,000 of chronic illness benefits, and something like what Tony is describing happens. Well, they can use this in the meantime. So I see those riders that they don't really cost anything, just as a bridge until we can afford a more formal long-term care, right? So again, they're not bad. I wouldn't stop promoting them and using them. I will promote them and continue to use them, because having that instead of having nothing, I might as well have a chronic illness. But we understand that it's not going to take us all the way or as far as it should, right? And it doesn't carry the same benefits as an actual long-term care system. So I think right there you have two great sales ideas. So to wrap it up, you guys saw how to make comparisons to other contracts. You learn that there's a tax issue coming down the pipeline where we're going to get taxed in most states to actually pay and finance long-term care situations, right? Especially as Medicaid continues to expand to the rest of the states in the country. So that's another sales idea. And then looking at what they have and look at the riders that you can expand on, so you can provide them with actual benefits. And obviously we have annuity care, but we haven't talked about annuity care. We'll talk about it next time when Jen comes back. That's really all I have for you guys today. On Wednesday, we're going to talk about strategies that we couldn't get onto today. So we'll leave that for Wednesday. So make sure to not miss it. But any last minute question about AssetCare or what Jen covered today before we wrap up our class? Anything else? Nope. All right, guys. Well, we have a full complete week. Let's make sure that we take advantage of it. I'll be speaking to most of you individually over the next couple of days. Oh, yeah, I forgot. Sorry, Shardy. We have 2 introductions to make today. So we have 2 new team members. We have Amanda here, and we have Patrick. So let's start with you, Amanda. Do you want to share with the team a little bit about yourself, your 45 seconds bio, and what do you think about today and what brings you to the team?
Yeah, hi everyone. My name is Amanda Musker. You can call me Mandy. I have 10 plus years of experience in the healthcare industry. So I started out with being an IME, independent medical exam coordinator for a New Jersey auto insurance company, and then wandered into the health insurance field, worked about 9 years for Independence Blue Cross, a subsidiary called AmeriHealth Casualty Services. So I was a claims adjuster for workers' compensation claims. And then I've also done account management with them, and also for an independent review organization. I dabbled in group health, national accounts, as well as workers' compensation. So this is my first day today, so I'm like really excited. I'm excited to learn a lot. I already learned a lot and took a lot of notes during that presentation. So excited to meet you all, to be part of the team.
Awesome. Well, thank you, Mandy. We appreciate it. Patrick, give us your, want to give us your 30, 45, 55 second bio and kind of what brings you here.
Yeah, absolutely. First off, thanks for having me, guys. I'm really excited to be here. My name's Patrick. I don't have really a great nickname. You can call me Pat, hey you, doesn't really matter. But I've been in sales for the last 15 years, most of that time in sales management, leadership, that space. The last 6 or 7 years, I've been in the insurance and financial sector. Lots of experience in the health and life, definitely on the financial side of the life side. Really excited about being here. Learning this information today is just another piece to really help the people that we're talking to, and other things that we can bring to the table so that we're giving everybody a full picture and really helping them completely, which is super exciting to me because not every organization wants to do that. And that's why I'm excited to be here, is that it's full circle, it's complete review, and we're out there helping people, which is why I got into insurance in the first place. So, you guys will learn more about me later on. Obviously, you can see I have a dog back there working on getting the background here. So dogs aren't in the picture every time. Yeah, thanks so much for having me, and I'm excited to get to know you guys and be a integral part of the team.
Thank you, Patrick. And we can see the dog is stoked about AssetCare. He's super excited about it. Look at that. He enjoyed the meeting. So,
didn't put her to sleep at all, for sure.
Not at all, no. Well, excited to have you guys. Thank you for being here. And yes, we're trying to do the best we can for our clients. This is just another tool that we can, and obviously you see the need, and it gives an opportunity to work with clients and build your practice. We'll talk about, how AssetCare pays and your comp and your renewals next time, but it's a great product for you and for the clients. So that's what we like to be. It's a win-win for everybody. So again, welcome once again. Excited to have you. See you guys on Wednesday, but I'll talk to you individually. I have some meetings with you tomorrow, Patrick, so we'll talk more tomorrow. For the rest of you, let's have a successful week. Let us know if we can help. And let's go at it. Let's get it. Thank you, guys.
Thanks, Junko, and welcome to the team, Mandy and Patrick.
Bye.
Thank you.
Bye.